Many investors who want to balance their portfolio invest into long-term government bonds because they're very secure. According to the UK Times, 10-year Brazilian bonds could be a promising opportunity as they yield 9% interest per year. European sovereign bonds, on the other hand, currently only offer an annual return of 0%. The Brazilian bonds thus have an interest advantage of 9% per year. Is it therefore profitable to exchange euros for real and to invest in Brazilian bonds? By simply looking at the difference in interest rates, the answer seems to be yes. If we invest 1,000 euros in Brazilian government bonds, we receive an annual return of 90 euros. If we invest the same amount in bonds from the euro area, we receive €0 per year.
When making an investment decision, it is crucial to take the development of the exchange rate into account, as we need to convert euro into Brazilian real to purchase Brazilian government bonds. After 10 years, we receive the invested amount back in real, and we have to exchange it to euro. If the real loses, on average, yearly more than 9% in value, we receive less than we have initially invested. Following the shock of the COVID-19 pandemic, the real depreciated by 30% against the euro over 2020. That is quite common for times of turmoil, as investors withdraw their capital from emerging markets, like Brazil, and prefer to park it in so-called safe havens, like the United States or Switzerland. This decreases the demand for real, and thereby the value of the currency. A depreciation of the extent of 2020 would have made an investment unprofitable.
But how likely is it that such a strong depreciation reoccurs?
This depends on 3 factors: the current valuation of the real, the inflation rate, and the policy of the Brazilian Central Bank. First, the current valuation. Identical goods are noticeably cheaper in Brazil than in the euro area. Let's take the price of a Big Mac, which costs on average €5 in the euro area. If we convert this amount into real, we can purchase roughly 1.5 Big Macs in Brazil. As prices of identical goods ought to equalize in the long run over the exchange rate, we can expect the real to appreciate. Second, the inflation rate. If prices in Brazil rise by more than in the euro area, we need more real to buy €1. The value of the real will decrease, and it will depreciate against the euro. Currently, the Brazilian inflation is at a level of 8%, whereas inflation in the euro area is at 2%. This difference would result in a depreciation of nearly 6% due to inflation. However, even if this effect fully materializes, the Brazilian government bonds with a yield of 9% will still be 3% more profitable than the European ones. To predict how it will develop in the future, we should have a look at the third factor, the Brazilian Central Bank policy. It plays a crucial role as it is responsible for price stability. There are good reasons to assume that the central bank will bring down inflation as it has done so in the recent past. Further, we can expect even lower inflation rates in the future, since the central bank will lower its inflation target from currently 3.75% to 3% over the next 2 years.
Overall, we believe that the strong depreciations of the real during the pandemic have been only of temporary nature. The current undervaluation and the inflation target of the central bank indicate that the real will not depreciate by more than 9% per year. Therefore, we expect the Brazilian government bonds to be profitable.